Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Boc Aviation Limited annual report. Boc Aviation Limited offers a diverse range of services to airlines and aircraft owners across the globe. At its core, the company provides leasing solutions, including direct operating leases and finance leases for aircraft and engines. This allows airlines to acquire the necessary assets without bearing the full financial burden. In addition to leasing, Boc Aviation also offers sale and leaseback facilities, which enable airlines to sell their existing aircraft while simultaneously acquiring new ones through a lease agreement. The company's asset management services cater to banks and other investors, providing technical expertise in managing aircraft fleets. Boc Aviation services extend beyond leasing and asset management. It provides debt financing and financial support to airlines, helping them navigate the complexities of aircraft acquisition and operation. Furthermore, the company offers remarketing services for aircraft, ensuring that clients can sell their assets efficiently. The company operates a significant fleet of owned, managed, and on-order aircraft, making it a major player in the global aviation industry. With its headquarters in Singapore and roots as a subsidiary of Bank of China Limited, Boc Aviation has established itself as a trusted partner for airlines and investors worldwide. Boc Aviation Limited market capitalization of $53 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Boc Aviation Limited holds a significant advantage in their industry. Boc Aviation Limited trades at a higher price-to-earnings ratio of 8 times and a higher price-to-book ratio of 1.05 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 75% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 4.22%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth or decline can be summarized into several key factors. Revenue growth is primarily driven by the increase in order book, with a record total revenue and other income of over $12.6 billion. The delivery of new aircraft and engines, as well as sales of owned and managed aircraft, have also contributed to revenue growth. Additionally, commitments to purchase 160 aircraft and development opportunities have further boosted revenue. The leasing of aircraft and engines to airlines in key markets, particularly those participating in the Belt and Road Initiative, has also been a significant driver of revenue growth. Furthermore, the company's active portfolio management strategy, which includes increasing delivery of aircraft and sale of older aircraft, has helped to maintain stable average costs of funds. On the other hand, revenue decline is primarily driven by a decrease in other income, with a 63% decrease reported. This decline was partly offset by an increase in lease rental income and interest income from finance leases. In terms of mixed results, lease rental income increased by 2.18%, while interest income from finance leases increased by 24.93%. However, net gain on sale of aircraft decreased by 81.13%. Overall, the company's revenue growth is driven by a combination of factors, including an increase in order book, delivery of new aircraft and engines, and leasing to key markets. While there are some areas where revenue has declined, such as other income, the overall trend suggests a positive outlook for the company's revenue growth. The financial performance of the company has shown significant improvement over the past year. A notable increase in net income was observed, rising by 18% from $746 million in 2024 to $787 million in 2025. This growth can be attributed to various factors, including improved contributions from all major business activities. The profit margins of the company have also seen a positive shift, with an improvement due to enhanced performance across its core operations. The increase in net income and profit margins is a testament to the company's ability to adapt and thrive in a competitive market. The company's financial performance indicates a strong ability to generate operating cash flow. According to various summaries, the company has consistently produced positive operating cash flow over the years. In fact, it has reached historic highs in some instances, with net operating cash flows of $2.2 billion and $24.2 billion in 2025. The majority of the summaries confirm that the company is generating positive operating cash flow, with only a few minor discrepancies noted. The consensus among these summaries suggests that the company's financial health is robust, enabling it to generate significant amounts of operating cash flow. This trend is expected to continue into the future, as indicated by the 2025 projections. In conclusion, based on the available information, it can be confidently stated that the company is indeed generating positive operating cash flow. The company's debt level and interest expenses have undergone significant changes over the past year. According to various reports, the gross debt increased by 2.6% from $16,668 million in 2024 to $17,228 million in 2025. However, there are conflicting information on debt level changes across different pages, with some indicating an increase and others showing a decrease. Despite these discrepancies, it appears that the company's total debt has generally increased or remained stable over the past year. The net book value of loans and borrowings also shows an increase from $16,573,763 in 2024 to $17,149,868 in 2025. However, there is one instance where the total loans and borrowings decreased from $10,267,470 in 2024 to $8,992,773 in 2025. On a more positive note, interest expenses have decreased slightly over the past year. According to reports, interest expenses decreased by $10,249 from $207,666 in 2024 to $197,417 in 2025. Additionally, estimated interest and net swap payments increased from $2.77 billion in 2024 to $2.53 billion in 2025, representing an 8.6% decrease. Overall, while the company's debt level has generally increased or remained stable, interest expenses have decreased slightly over the past year. The financial performance of the company varied across different segments and regions. On the positive side, Asia-Pacific consistently performed well across various metrics, while Belt and Road Initiative countries and regions excelled due to high demand for aircraft leasing. However, several regions struggled with poor financial performance. The Americas were a notable underperformer, experiencing stagnant revenue growth and declining finance lease receivables. Europe also faced challenges, with no revenue generated in 2025 and a decrease in finance lease receivables. Additionally, the Middle East and Africa, as well as Chinese mainland, Hong Kong SAR, Macau SAR, and Taiwan, all saw decreases in finance lease receivables, indicating areas that require improvement. Management is optimistic about the company's outlook, citing a strong order book that will maintain high earnings visibility. This confidence is reflected in their plans to invest significantly over the next few years, with a total of $19.1 billion allocated from 2025 to 2029. The company's funding strategy will prioritize debt maturities and capital expenditure, ensuring that it has sufficient liquidity to execute its growth plans. Management is also focused on executing transactions and managing the aircraft portfolio efficiently, with a clear governance framework in place. In addition to these investments, the company plans to dissolve several subsidiaries in 2026 as part of its efforts to streamline operations and improve efficiency. This move is expected to provide further cost savings and enhance the company's overall financial performance. Overall, management's strategy is centered on executing its growth plans while maintaining a strong balance sheet and ensuring sufficient liquidity to support its capital expenditures and borrowings. The company has a history of paying dividends to its shareholders. In fact, it has declared and paid dividends for the year 2025, with a total proposed dividend amounting to $314,900,000. This indicates that the company is committed to returning value to its investors through regular dividend payments. A closer look at the figures reveals that the final dividend recommended for 2025 was $3,061 per share, while the declared and paid dividends for the year totaled $287,737. These numbers demonstrate a clear focus on rewarding shareholders with a portion of the company's profits. There are concerns about inventory buildup and supply chain disruption in the industry. While there is no significant inventory buildup to report, aircraft shortages and a notable 26% of aircraft being deferred into future periods suggest potential issues on the horizon. Supply chain disruptions, however, are ongoing, with delivery backlogs affecting 60% of the installed fleet. Furthermore, engine availability is limiting production ambitions, exacerbating the problem. These challenges highlight the need for careful management to mitigate potential risks and ensure a smooth supply chain operation. That concludes the financial summary for Boc Aviation Limited. Feel free to comment below, and I will be happy to answer them when possible.